Times when the technicals line up with the fundamentals, and recently technicals have started to turn down in the short run. So all those are important. And Tesla, as you said, it's a stock where everybody has this, they want to invest in a wonderful car and a visionary leader similar to those with Amazon and Apple and the others. And so, sometimes the stock doesn't always reflect what the fundamentals might say. And so that's why technicals are, incredibly even more useful during times like this.
There's a new Tesla valuation model that we find very interesting, and we think you should see it too. Remember when Elon Musk said that the value of Tesla is primarily on the basis of autonomy? Well, we're about to see this in terms of actual numbers. As the Tesla CEO once said, the short-term variances in Tesla's gross margins and profitability are actually minor relative to the long-term price. In his words, autonomy will make all other Tesla numbers look silly. That is a very bullish comment. That's why in today's video we're going to explore Tesla's latest valuation model and see what could potentially lie ahead for anyone who is interested in investing in Tesla. Let's dive in.
Switching gears here and zeroing in a little bit on earnings season, which is kicking into higher gear this week. Investors eagerly awaiting results from big tech stocks. That's after the Nasdaq was dragged down by second quarter results from Tesla and Netflix last week. Tesla's recent pullback overshadows the company's beat on the top and bottom line. And it got downgraded this morning as well over at UBS. So interesting there. We're seeing those shares pull back in pre-market trading. Mark Newton is still with us, Fundstrat Global Advisors, head of technical strategy. Mark, we wanted to sort of dig into some specific names a little bit, and Great. Tesla is one of them. Obviously, it is of huge interest to people. So what's the setup look like after what we saw last week?
Well, look, Tesla has had an incredible rise. It's rallied over 100% just since the middle part of April. So it's difficult for stocks to go just in a linear direction straight up without any sort of correction. So it has gotten near-term overbought. There were some instances of the stock price moving up, but momentum has not followed of late. So that's a technical concern that sometimes means that the stock might need to consolidate. So it hit $300, and recently we've seen a little bit of backing and filling in the last week. They've downgraded today. It's down to 256. So it's getting closer to an area where investors might want to consider buying dips technically. But, you have to realize that the stock is incredibly volatile compared to many other stocks. I mean, it turned negative last year. Elon Musk sold shares back in October, November. The stock literally got cut in half. It went down to almost 100. And so now here it is at 256. So still, a very, very good rally. And if anything, on an intermediate term basis, it's actually gotten a lot more bullish.
Tesla's forward-thinking approach has appeared to help it maintain a competitive edge in the electric vehicle market. As the demand for sustainable transportation grows, this company is well positioned to capitalize on the shift towards clean energy solutions. Investors who recognize Tesla's commitment to its mission and its unconventional yet successful strategy often view the stock as a strong long-term investment. And we think this should be the thought of every Tesla investor out there. Hey guys, welcome back to Tesla Tomorrow. Tesla's ambitious goals, including its plans for autonomous driving tech and energy storage solutions, have the potential to generate significant revenue streams in the future. One thing we know is that Tesla can already make a lot of cars at lower costs than any other legacy car maker outside of China. But that's not where the big money lies. The automaker's biggest revenue is going to come from its technologies, where Tesla is basically untouchable by its auto peers. This is what we know for now and could remain for the foreseeable future. So what's this latest Tesla valuation all about? Let's find out. But before we start, if you like this type of content, hit that like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. This valuation model is focused on a conceived estimate of Tesla's robotaxi network. It predicts that Tesla sells its vehicles at cost and only makes money from FSD software subscriptions and robotaxi revenue. The automaker sold a cumulative 4.9 million vehicles in the second quarter of this year, and let's say it sells about 130 million vehicles by the end of 2035, and these vehicles actually form a robotaxi fleet for Tesla. Excluding all other revenue from energy, insurance, supercharging, service, dojo, and bots, Tesla will only make money from FSD and autonomy. For this model, Tesla could make up to $300 billion in revenue from FSD by 2035, and about $580 billion as FSD autonomy revenue in the same year. Combined annual potential FSD and autonomous revenue by 2035 could expand to $895 billion. Applying a net profit margin of 35% and an earnings multiple of 30 to these revenue figures gives a possible market cap of $9.4 trillion for Tesla in 2035, just 12 years from now. So with this market cap, how much do you think Tesla stock can be valued by then? Do share your thoughts down below in the comments. Now, Tesla reported solid financial results for the second quarter, beating expectations across the board. Deliveries soared 83% year over year as the company leaned into discounts, with revenue rising 47% and net income climbing to 20%. However, Wall Street pointed out issues with price cuts, which thus pushed Tesla's operating margin to a 2-year low, with the stock price also slipping 10% following that same report. Several analysts do not believe that Tesla has good demand, but let's view from this perspective. Ford, GM, Rivian, Volvo, Polestar, and more have said that they will build their electric vehicles with Tesla's North American charging standard beginning in 2025, so their customers are going to have access to Tesla's supercharger network. Charging companies like Electrify America and others have also pledged to add NACS to their existing network as well. This charging network has long been one of Tesla's biggest strengths, and could be a major booster for its demand. For instance, this charging deal is supposed to be a huge advantage to non-Tesla car companies that are switching to Tesla's charging tech, and some experts in the automotive industry have said that this could be why car shoppers should hold off on buying an electric vehicle other than a Tesla at least for the next 2 years. Simply put, anyone looking to buy an EV should only be considering Tesla. With automakers, charging providers, and more companies moving to Tesla's tech, CCS will be far less common in the coming years. So why buy cars with this charging port when you still need to spend more money on adapters? Almost all EV users except Tesla owners are looking at futzing around with adapters for the rest of their ownership, or somehow trying to pay to have the new plug system installed into their car. And that's where the federal tax credit helping to lower Tesla's car prices comes into play. Tesla could also earn up to $1 billion just from federal battery tax credits alone this year, and will add another $1 billion or so in cost savings from the drastic reduction in the price of lithium and other metals. Drastic cost savings, thanks to the government's genius and generous tax credits for new EVs and their batteries, as well as the fall in lithium prices, have all allowed Tesla to surprise analysts with much better earnings than expected, despite the up to 30% EV price cuts earlier this year. From the $0.35 per kilowatt hour federal incentives for battery production, Tesla expects to earn up to $250 million per quarter, probably $1 billion this year. And who knows, another $1 billion in cost savings may also come from the drastic up to 80% fall in the price of lithium and other component materials compared to last year. According to Elon Musk, the combination of government incentives, component cost reduction, and increased production efficiency have all allowed Tesla to take its price war aftermath in stride, and is now ready to do it again if markets deteriorate. No doubt affordability of these cars can negatively be impacted with market challenges, such as rising interest rates. However, if the market condition is stable, then prices will likely be stable. How much do you think Tesla can potentially make from FSD and autonomy? Let us know down below, and don't forget to tell us what your valuation of Tesla is. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.